Good afternoon, everyone. Welcome to this call webinar, which is the NFO launch of HDFC Diversified Equity All Cap Active FOF. So this is an NFO which is starting on 10th September and we will end it on 24th September. So what this NFO is all about, how will we manage this? To discuss this, we have Srinivasan Ramamurthy, who will be the fund manager of this fund. And Srini, as you all are likely to know, manages most of our hybrid strategies and a few other equity strategies as well. So I'm not going to spend more time on his introduction, but I will spend a little bit time on the introduction of the fund itself. So what is the need for this fund? Um, Equity investing for Indian investors is not new. A lot of investors have been equity investors for decades now. But over the last, say, 10 or 15 years, more and more individual investors have taken to the equity markets, uh, primarily through mutual funds. A lot of them are SIP investors, a lot of them are hybrid fund investors. A few asset allocation products have also become very popular. However, when it comes to equity investing, there is always this kind of uh, dilemmas in terms of the investor's mind, in terms of which product to select. I mean, so many products are there. There are thousands of products out there. Which one to choose? Which capitalization I should invest now? Large, mid, small. I mean, most of the intermediaries, the distributors here who are present in this call are likely to have encountered this question: which is large cap better or mid cap better? Which sector is better? So many questions come around that. And finally, when to rebalance, whether I should change my allocation from large to mid to large, or small cap. So with the launch of this product, we want to bring a solution to the investors wherein the investor doesn't have to worry about exactly where to invest. We want to add a touch of professional management when it comes to management of equity mutual fund, not just equities, but equity mutual funds itself. So in this product, we will have seven of our key products, right from large, mid, small, flexi, multi, large, and mid. So you can call it a 7-in-1 product. Not likely all seven may be there, or sometimes six or seven, but the underlying universe of this fund will be seven of our own mutual fund schemes. So that's why this is called a fund of fund. So the name of the fund itself tells what it is: diversified. So it'll bring as much diversification as possible. Equity, all cap, all market caps we would like to encompass, and it's an actively managed FOF. So once the investor does the asset allocation, which is the primary most important step in financial planning, after the asset allocation is done, whatever is the equity exposure, the suggested or the ideal equity exposure is required, that's when we start looking out for various avenues, maybe various mutual funds, how much large cap, mid cap. So this is aimed to be a one-stop solution. I'm sure Srini will cover this all these part in a very detailed manner when he starts his presentation. Just wanted to also introduce. We have an internal framework when it comes to managing this portfolio. So we call it the VLSM approach. So more from Srini on that. So this framework-driven approach is what we believe is a value add that we want to bring it to the table when it comes to managing the equity mutual fund portfolio of individual investors. And just want to spend a couple of minutes on HDFC MF's core philosophy and the processes and the rigor with which we do research, because the underlying schemes are going to be HDFC MF large, mid, small, flexi cap schemes. So you all know that we have many of our funds have a track record of over 30 years, 25, 30 years. So you will get the legacy of that continuing for the next maybe 20, 30 years in this portfolio. So we would like to believe that it is the philosophy or the ecosystem that has delivered this alpha. So you'll get that entire ecosystem in a single product. The rigor to which we do our research. I mean, in our investment team, we have the analysts for each sector, and there is an active coverage of over 400 stocks. The depth to which we cover is we would like to be believed to be the best in class in the industry, and we would like to bring all those expertise and experience to one single product, and that's why this product is a very important addition to our array of offerings in the equity side. So with that, I will invite Srinivasan to take over and discuss in detail our NFO, the all cap equity. We also calling it the ACE advantage because all cap equity. In order for the easy reference of this product. So over to you, Srini. You can discuss in detail the offering.
Yeah, thanks, Ram, and welcome everyone to this webinar on this HDFC diversified equity all cap active fund of funds. Of course, the name is a really long one and a bit complicated. Hopefully, the product is not. I mean, the intention of the product is actually to simplify life for investors, like Ram mentioned, and that is what I would kind of seek to do, try and kind of quickly summarize the thought process behind how we will look to run this product, and give you some flavor around that. So the reason why this product is obviously getting offered, like Ram mentioned, is it wants to kind of give investors I think as investors, one of the key challenges that we face is your discipline. I mean, maintaining an investment discipline and controlling the investment behavior. And these are two aspects which we try and address through this product. And that's what I would try and kind of get into a little bit more detail as we talk through this slide work. So one of the analogies that we have kind of presented, I think it's a fairly accurate one to some extent. What we are saying is that this is a product like in any cricket team. What you want to do is to have a team of players who represent different facets of the game. So in a game of cricket, for instance, within your team, you want to have experienced batsmen, dependable bowlers, and all-rounders. And in that same vein, what we want to do in this product is to have a mix of large caps, mid caps, and small caps, and kind of change that mix the same way that you look to build your team depending on the pitch and the weather and things like that. The same way we would like to look to kind of, depending on different market conditions, we would want to kind of reallocate this mix accordingly and kind of build out the portfolio. When we talk about any equity offering, I think as end investors, obviously there are a large number of choices that you are kind of presented with at any point in time, and that is something which makes the job very tough to choose which fund to allocate at what point in time, and the job gets even tougher in situations when you have to kind of take into account different market variables as well, the different investment time horizons. So those are the aspects that we are trying to kind of address by offering a product which is in a way one product for you as an end investor, but the product in itself is actually encompassing a large number of products that we have. And I would talk about the products that are underlying in this product, which we are kind of bringing in a mix and a format that can be easily understood and kind of participated through just one product. So what we see is that when we kind of look at India's history in terms of, I mean, just last couple of decades of history itself, last 20 years, what we find is that across the different market cap segments itself in the marketplace, you keep seeing that on an annual basis, the winners keep changing. So, and that is something which is extremely difficult to ascertain that which sub-segment of the market is going to perform at what point in time. And what you would also see in this table here on the left-hand side is that there are periods when a category underperforms or outperforms for even multiple years at a stretch. And this is what leads to what we call as which can probably lead to some investor behavior errors that can creep into it when you kind of see this kind of an outperformance, underperformance. We'll talk about a little bit more in terms of the recency bias and behavior issues that can potentially creep in. But the idea is that it is very difficult as end investors to make out which subsegment of the market is going to do well, and within that to kind of and then to take a forward-looking call in terms of how to allocate assets going ahead. But at the same time, when we see such kind of a large divergence in performance over the shorter term time horizon, when we look at longer time horizons, whether it be over a decade or even longer, the the performances seem to kind of converge quite regularly. I mean, of course, when you look at point to point, there might be periods when even over a longer time frame, you might find some differences in outcomes. But over time, generally speaking, these kind of performance, the gaps in performance tend to kind of narrow down reasonably to a reasonable extent. But at the same time, because of these variations, what happens is that particularly in portfolios which do not get rebalanced, there are some interesting outcomes that you get to see. So for instance, here we have kind of highlighted two case studies to kind of make this point about a lack of rebalancing in the portfolio. So if you look at a portfolio which kind of started somewhere between in the Jan of 2014, if you had started off by allocating say about 50% to large caps and the remaining 50% equally between mid and small caps, what you would find is that on the following 3-4 year time horizon, given the fact that the mid and small caps did exceptionally well, the allocation to mid and small in your portfolio would have automatically grown to about over 60%, what initially started off at 50%. And this is when in 2018, when you did see a reasonable amount of market volatility and you saw a sharp price correction in the marketplace, and this was largely driven by mid and small caps, you were overexposed to this segment as a category. And this is something which is something probably which would have been avoided if you had rebalanced on a more regular basis. But given the fact that you had a buy and hold kind of a strategy as an end investor, one might have kind of been kind of seen a relatively higher level of volatility in your portfolio if you had not done that rebalancing. The same kind of a thing played out in a inverse kind of a manner. When you look at the second case study that we have shown, which is between the calendar year 2018 to 2020. So here, if you had started off somewhere in December 2017 with a 50% allocation to large caps and the similar 50% split between mid and small, by the end of March 20, and obviously there was this COVID-related impact that was also played out, you would have seen this buy and hold kind of a portfolio's share of mid and small falling off sharply to below 40%. And this would have meant that this portfolio, as opposed to a rebalanced portfolio, would have been under exposed to a very sharp kind of a price up move that we saw in a subsequent time horizon. In the case of mid and small caps, you saw over 100% return in the subsequent year. And in particular, there was a meaningful outperformance to large caps. So these are these are areas which kind of bring in volatility into your portfolios, and you might get overexposed or underexposed simply because you have kind of chased momentum inadvertently by not rebalancing your portfolio at times when you probably would have done if you had stuck to a certain investment discipline. So, and this kind of a rebalancing, lack of rebalancing gets further exacerbated when you look at from an investor behavior standpoint, where recency bias also creeps in. You find this kind of become a lot more pronounced. So here, for instance, if you look at this is obviously a relatively shorter history that we have chosen because the data availability is not, I mean, segment-wise data availability is not for such a long period. So this is a slide where I think what you would see is that we have, I mean, like Ram pointed out, it has a fair number of rows and columns. So the idea is that between quarters of FY20 and FY22, we have just plotted the share of large cap flows in overall gross equity flows to see what market share of large cap fund flows were. And we have tried to map it against the relative performance of large cap to small cap. I mean, this is the last column that you see there in this table. And the point that we're trying to drive home here is that during the period, the first few rows that you would find in the first few quarters of the FY20 and FY21, you would find that the outperformance of large cap versus mid and small was fairly high. And this is something which we even saw in the previous slide. This was a period when large caps were doing fairly well. And you saw the market share of large caps being fairly high as well. So you saw almost 20, 21%, 22% market share in overall cross equity flows for the large cap funds as a segment. Come 2021, the second quarter of 2000 FY21, and you started seeing, and as you went forward, you started seeing mid and small caps start performing. And the large caps started to underperform versus the small caps and mid caps and some of the other thematic categories as well. So it was a much more broader market rally. And you saw that the flows, which were the flow market share, which the large caps were having at around 20% plus, started falling very sharply, and it fell to almost 12, 13% by the end of this period. So it's almost halved. So this is the kind of demonstration of this recency bias which investors have, that in the recent months, in the recent quarters, the segment which of the marketplace which does well, people tend to allocate a lot more to that segment. And this further adds to the fact that you are not, if you are kind of buy and hold kind of an investor and incrementally you are doing a lot more of this, what it means is that on your overall portfolio basis, you tend to have a much higher exposure to a segment which has also had a lot more momentum going for it in the past few years or quarters. And in a way, inadvertently, you get exposed a lot more than you want to a segment which can potentially see a lot more volatility in the future. So, and clearly this is what we want to, I mean, our aim would be to kind of avoid this kind of recency bias and this kind of a lack of rebalancing when we kind of look at how we run this product per se. The overall, I think, in terms of the way that you, an end investor would like to run his own rebalancing, I think there are a few friction points which we are kind of highlighted. I think these are fairly obvious ones. I think, I mean, just to kind of reiterate, any kind of rebalancing activity at your end, at an end investor's end, would require a fair amount of time and resources which needs to be done, which needs to be allocated to the activity. In addition, there are obviously transaction costs which get involved, whether it be in terms of your exit loads, if you are to kind of getting out of some product, getting into some other fund, in terms of the taxes that you might need to pay in terms of capital gain taxes, if you're, and depending on time horizon of holding, whether it's a short-term, long-term capital gains, and then like what we talked about, the friction of investment behaviors. So these are the kind of frictions that naturally comes in when we are thinking about do-it-yourself kind of portfolios, which is what we are trying to avoid in this kind of a product. So coming specifically to the product itself, I think most of the aspects that I broadly highlighted are kind of summarized in this one slide, where the key activity that this fund wants to kind of perform is it tries to get an exposure to the entire HDFC equity team through one product. And that is the whole idea. Here, I mean, we have multiple funds being run by multiple fund managers. And the idea of this one product is to get you an access to all those fund managers, and with all the diversified styles in under one roof, you get an exposure to that. And as we spoke about, we have multiple market cap exposure, segments exposure, whether it be large, mid, and small. And all these individual segments will be determined basis. I will come to the framework a little bit further down, but basis of framework, which means we would try and avoid being pro-cyclical or being momentum chasing in terms of the way we allocate to these different subsegments of the market. There will, of course, be a periodic rebalancing exercise that we would look to undertake, and these rebalancing exercise would ensure that that some of the pitfalls that I mentioned in the earlier slide of being overexposed or underexposed to a certain segment, we could try and avoid that. And then, of course, as an end investor, you have less amount of friction to kind of deal with. This is because it's just one product where you are kind of taking exposure. All the rebalancing happens within the product. So to that extent, the changes, the issues around exit loads or capital gain taxes being paid at different points in time, those do not arise. And that's what we kind of try and make it a little bit less, a little bit more friction-free for the end investor. So this is something which I think Ram initially highlighted when he spoke about the fund of fund and the vintage that we bring as a fund house. So here in this product itself, I think we have 7 funds which will be part of this product, and these 7 funds together account for almost 3 in AUM. They almost represent close to 70% of the overall equity AUM that we manage as a fund house. The average vintage of these funds is upwards of 20 years. As you can see, almost all the funds have reasonably high vintage in terms of how long they have been operating and the track records that they have demonstrated over this time horizon. And that's what we kind of want to kind of bring forth in this one product. We give you an exposure to this entire, I would say, investment journey that we have had as a fund house, and we would continue to have going ahead as well. So we obviously, as a fund house, we have certain core philosophies, and there is a certain investment discipline that goes behind the way that we work across the equity team, and that is what is kind of demonstrated here. Most of you, having been associated with HDFC in some form or the other, would be aware of the kind of effort that we put to ensure that that the risks are adequately kind of taken care of while we run some of these products and kind of generate the alpha that we want to for end investors. So here we have kind of highlighted all of that. It's there is a very high level of investment discipline and long-term focus across all the products that we run, and the idea is to kind of bring all of that in under one roof in this product. When you look at the fund manager strategy here, I think it is something which is like I mentioned, the underlying philosophy that you get exposure to multiple fund managers with very diversified investment styles, and you have multiple, I would say, market segments getting exposed through this product. It would ensure that the journey for the end investor is a lot more smoother, because by definition in the marketplace we always find that a certain style does well at certain points in time. A certain market segment, like we saw in an earlier slide, tends to outperform some other market segments, and all of that generally tends to get neutralized in a framework like this, where we take multiple exposures across different market segments. So in general, the peaks and troughs kind of a product should ideally, we would as an outcome, we would expect that the peaks and troughs would be much lower than the peaks and troughs in a traditional kind of a single product exposure. And that in itself should ensure that the investor has more reasons to kind of continue with the journey and gets a little bit more comfort on a smoother journey that this product provides. Coming to the framework itself, I think this is something which I would want to spend a little bit of time on before I kind of hand it back to Ram, and we can kind of open it up for Q&A and address specific questions. I think at the base of the framework is, of course, that the core attribute is we are looking for a valuation sensitive counter-cyclical approach towards the segment rebalancing. And by segment, I'm referring to the different market capitalizations, because that is what this product will strive to do. Across the different market capitalizations, we would look to kind of take exposures, and the basis for this framework largely relies on a back testing that we have done. And this backtesting is fairly extensive, and it tries to remove all the biases that we can have. We might have as just as investors, when we look at certain segments doing well, the momentum and those kind of effects, we try and take it out. So the backtesting and the variables that we use can broadly be classified under four broad headings. Which is what the short term that we use is VLSM, which stands for valuation. So valuation basically talks about how expensive or cheap each of the subsegments are. And in a relative sense, obviously, we would prefer segments which are more attractively valued to segments which are more unattractively valued. Coming to sentiments, that is the second segment that we look at. And the sentiments is largely a function of how optimistic or how pessimistic the market behavior is, both on an overall aggregate market level as well as for an individual subsegment level. So here, which means that because it's a counter-cyclical approach, by definition, it would mean that when the market is extremely pessimistic about the outlook for a certain subsegment of the market or for the overall market itself, we would tend to be a lot more aggressive. And the reverse holds true. When the market is very, very optimistic, we would tend to be a lot more cautious. The liquidity part, this is something where we largely would be a function of how the money supply growth in the economy, both in domestic and the global markets is. And that generally we've seen has a very big bearing on how broad or how narrow a market behaves. And finally, macros. I think this is, of course, while it is one of the most important aspects for any economy and any subsegment to behave, generally speaking, it is a lot less correlated. The correlations to markets can be a lot less, largely because of the fact that the macro itself is such a giant ocean that it is very difficult to pinpoint which aspects of the macro matter to markets at any point in time. But at the same time, we do try and factor that in as well to the extent possible. And this is how the framework will largely operate. And basis this backtesting, we would come out with outcomes in terms of what allocations we should do at any point in time to the different market segments. And there would be a rebalancing frequency. In this case, we would be rebalancing at every month end. There will, of course, be times when market movements are very, very sharp. That might need some intra-month. Within a month, there might be some needs sometimes might arise. It may not be very, very frequent, but it might still come up. And we are open to such intra-month rebalancings as well, as and when the need for such a rebalancing arises. So net overall, I think basis these factors and the outcomes that we get from these factors, we would look to kind of have build out a portfolio which has got reasonable diversification across market caps and across the fund managers, because there are different fund managers, like we spoke about, managing the different products that are underlying to this fund of fund. And the overall end outcome that we would expect from this is to provide the investors with a smoother investment journey and a wealth creation platform where they can stick on for longer, simply because of the fact that they would have lesser reasons to be kind of disappointed very sharply during a market volatile phases of the market. So that would be the end endeavor that we would look to kind of achieve through this product offering.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.